Nick, great to have you here this morning. As always, Managing Director of Equity Research. Walk me through what you learned in these earnings, Nick.
Yeah, there were two surprising things that came out from the U.S. business, first and foremost. First, the stores that are open, the 50% of the stores that are open, are still down 25%, and all of them have drive-thrus. If you compare that with, the QSR names that have drive-thrus, they're probably down in the 15 to 20% range. So, that gap between QSR and Starbucks was a little surprising, particularly since historically there's been a pretty high correlation of stores being closed and the comp going up because of that. So there's a sales transfer that I think the street was expecting to benefit the stores that were open that really didn't materialize. And the second point is that clearly Starbucks may be demonstrating that it is a little bit more economically sensitive. So that customer base could be a bit more economically sensitive. And so perhaps, relative to QSR particularly, the sales aren't holding up as well. And yet the stock has actually outperformed the QSR space. So those were the two, big takeaways from the U.S. From China, the sales trends down 35, in April. Again, compared to Young China, for example, that's down 10% now, is maybe an indication that not just in the U.S., but globally, that customer base may be a little bit more sensitive to any kind of an extended economic downturn than we all thought going in.
This is what's interesting, Nick, is the company had been a relative outperformer to its group, and we saw early on that they were able to adapt in some ways, pick up, take out, delivery for some of the stores in the U.S., trying to be early to get back on their feet in China as well with smaller shops. And then they come out and give the outlook that is obviously bad, maybe not as bad as some of the expectations, but still ugly double-digit declines. The shares a little changed this morning. Walk me through why you're raising the price target after a report like this.
Well, previously I was giving it a 20% discount relative to its historical valuation, and now I'm giving it a 15% discount just because we do have that incremental visibility on the opening cadence, both in the U.S. and in China. So I'm giving it a little bit less of a discount than I was previously. So that's really the main difference.
Okay, I see. Down 5% revenue growth, comp store sales down 10%. What are the odds that they beat these expectations going forward, Nick? Are they setting a low bar for themselves?
I think they're being realistic. I'm not sure if it's a low bar. So we'll see how, no one really knows, particularly in the U.S., what the progress may look like. And also outside of China, there's still so many unknowns around Japan, which is almost the size of China, Canada, Europe. So it's very hard for them to give, guidance outside of China. We really only got guidance for China. And so given all the variables and all the unknowns, really the estimates that we're putting out there along with our colleagues, on the street, it's a guesstimate at this point. And that's really the best we can do. And so we're all trying to be pretty conservative. And the hope is that, not just for Starbucks, but across all of our names, results actually end up being a bit better, than the conservatism with which we're putting our estimates out there.
They're looking to open U.S. stores within the next couple of weeks. There's going to be limited seating options. They're continuing to find ways to stay in business. Nick, it's part of the challenge that a lot of investors were talking about for this company earlier in the year before coronavirus was Luckin Coffee, the IPO and the competition in China. Obviously, that's dwindled to say the least. I mean, what role does that play here? Did Starbucks get a bit of a lifeline with the blow-up of Luckin?
I think it's definitely helpful, on the margin. But, Luckin was really going after a different customer and was playing, in a very different segment of the market. The Starbucks has a very premium positioning in China. They don't even open their stores until 11 a.m. in China. 80% of that business is people coming in, sitting down to have coffee. with their friends, versus 80% sort of off-premise in the U.S. So it's a very different business model in China. And Luckin was really trying to go after the segments that, Starbucks didn't play in. And so it was 100%, takeout, really a much stronger breakfast, pre-11 a.m. business. And they were trying to play in the cheap sort of, the lower price point space. So, even to begin with, and I think early on, there were some concerns that, that could be incremental competition and that could potentially, harm Starbucks. But we never really saw it, even from day one.
All right, so the company's got a long ways to go here.